Imagine holding an investment that just delivered nearly 175% return in a single year. Your portfolio's up, the headlines are celebrating, and it feels like you made exactly the right decision. But here is the question that should make you pause. What if, at this very moment, while you are still celebrating, Wall Street is quietly walking in the opposite direction? Not publicly, not with bold headlines, just quietly, deliberately. This is the silver story of 2025, and more importantly, it may be the platinum story of 2026. Because in financial markets, the most dangerous moment is not when everyone is afraid. It is when everyone feels safe. Silver dominated the precious metals market in 2025. Prices surged from around $29 an ounce to hover near $79 by year's end. That is a gain of nearly 175%. More importantly, silver finally broke above the 1980 high of $50, a level that had capped prices for more than 45 years. For many investors, this breakout felt historic. It felt final, as if silver had entered a completely new era. According to recent investor surveys, more than half of retail traders now believe silver will lead the precious metals market again in 2026. They're not cautious, they're confident. They are buying at all-time highs, convinced that momentum alone will carry prices even higher. And on the surface, that confidence seems justified. Strong industrial demand, supply deficits, and a global search for inflation protection. Everything appears to be lining up. But this is where timing begins to matter more than belief. Here is the part of the silver story that makes many investors uncomfortable. Silver is now trading at price levels with no historical precedent. There are no tested support zones above $50, no reliable reference points, no proven floor. In other words, the market is moving without a map. Silver also carries a reputation that was not earned by accident. It is often called the most volatile major metal in the financial system, and history explains why. During previous bull markets, silver corrections from peak levels have typically ranged from 30 to 50%. In 1980, silver collapsed from $50 to $10 within 2 years. In 2011, a rally to $48 reversed into a multi-year bear market that eventually bottomed near 14. These were not mild pullbacks, they were violent resets. Today, analysts suggest that $50, the old record high that capped prices for decades, could now act as the new floor. But even if that assumption holds, it implies a drop of nearly 40% from current levels. And that's the optimistic scenario. So the real question becomes this: is an asset with limited upside, untested support, and a long history of sharp reversals really the best place for new capital right now? Or is the risk being underestimated precisely because recent gains feel so convincing? Now let's look at what Wall Street itself is saying, because this is where the story becomes more revealing. Major research desks are publishing wildly different forecasts for silver. Some analysts see prices falling back to the 50s, a correction of nearly 40% from current levels. Others project prices above $100 an ounce, requiring another 30% gain from here. When professional forecasts range from sharply lower to dramatically higher, that is not healthy disagreement. That is fundamental uncertainty. It tells us that the market is operating at extreme levels, where even experts cannot agree on fair value. And markets at extremes behave differently. They become fragile. Small shifts in sentiment can trigger large moves. In environments like this, new buyers are not stepping into clarity. They're stepping into a zone where risk is no longer symmetrical. Upside becomes harder to achieve. Downside becomes easier to trigger. This is often when retail investors feel most confident and institutional investors begin to grow more cautious. This is a pattern that repeats again and again in financial history. Retail investors tend to chase performance. They buy what has already gone up. Institutional investors behave differently. They focus on probability, on valuation, and on positioning before consensus shifts. Retail capital is emotional. Institutional capital is strategic. When an asset delivers a dramatic breakout, retail attention floods in. Confidence rises, fear fades. But institutions begin asking a different question. Not what just happened, but what happens next. They look for crowded trades. They look for asymmetric risk. And when positioning becomes one-sided, they quietly begin preparing for rotation. This is not done with announcements. It is not done with headlines. It happens gradually, quietly, out of view. And this is where the silver story begins to intersect with another metal that most investors are still ignoring. Platinum rarely captures attention. It doesn't generate headlines the way silver does. It doesn't dominate conversations. And that is exactly what makes its current positioning so interesting. Platinum finished the year trading near $1,250 an ounce, while gold trades above $4,500. That places the platinum to gold ratio near 3.6 to 1. Historically, this relationship looks very different. Over the past 50 years, platinum has typically traded much closer to gold, often at a premium. The long-term average ratio is closer to 1.2 to 1. Even during periods of weakness, platinum rarely stayed this discounted for long. What we're seeing now is one of the most extreme valuation gaps between platinum and gold in modern market history. This kind of dislocation does not guarantee immediate gains, but it does attract institutional attention, because when prices drift far from historical relationships, mean reversion becomes a powerful force, and institutions are paid to notice those imbalances long before they become popular topics. Platinum's valuation story is only part of the picture. The supply side makes it more compelling. Roughly 70% of the world's platinum supply comes from South Africa, and today that supply remains constrained. Production is still more than 10% below pre-pandemic levels, not because of a temporary disruption, but because of long-term structural issues, long-term underinvestment, infrastructure challenges, labor instability, and rising operational costs. Unlike many commodities, platinum supply cannot be increased quickly. New mining projects take 5 to 10 years to develop and require billions of dollars in capital. There is no switch to flip, no rapid response to higher prices. This creates a market where shortages persist even as demand remains steady. It also means that price signals matter. When supply is tight and inventories are thin, small shifts in demand can produce outsized moves. And this is precisely the kind of environment institutional investors monitor closely. Now let's compare the mathematics, because in the end, markets are not driven by stories, they are driven by probabilities. At current levels, silver offers limited upside relative to risk. Consensus targets suggest only modest gains from here, while downside risk remains significant if prices return to previously tested levels. In simple terms, new buyers are risking a large drawdown for a relatively small potential reward. Platinum presents a different equation. Even a partial return toward its historical relationship with gold implies meaningful upside. Not because everything needs to go perfectly, but because the starting valuation is already compressed. This is what asymmetric risk looks like. Limited downside supported by structural supply constraints, paired with upside driven by normalization, not speculation. Silver requires continued extraordinary conditions to justify further gains. Platinum requires only a shift back toward historical balance. That difference matters, especially when capital is being deployed with a 12 to 18-month horizon. This is where the data becomes especially revealing, because price alone never tells the full story. Positioning does. Recent futures data shows hedge funds and large institutions steadily increasing their exposure to platinum. This is happening quietly during periods of consolidation, not during moments of excitement. At the same time, speculative positioning in silver has reached crowded levels. In other words, most of the investors who want to be long silver are already in the trade. And when positioning becomes one-sided, markets become vulnerable. They no longer need bad news to fall. Even neutral news can trigger reversals. Late buyers rush to protect profits. Early buyers begin locking gains. Momentum flips faster than most expect. Platinum, by contrast, remains underowned. It is still viewed primarily as an industrial metal, not an investment asset. That lack of attention is not a weakness, it is the opportunity, because markets tend to move hardest when perception changes faster than positioning. Silver had its moment. In 2025, it delivered returns that exceeded nearly every expectation. That history is real, and it deserves respect. But markets don't reward yesterday's winners forever. They reward timing, positioning, and probability. Platinum may be setting up for its moment in 2026, not because it's exciting, not because it dominates headlines, but because it sits at the intersection of valuation dislocation, structural supply constraints, and quiet institutional accumulation. Wall Street does not advertise these shifts. It rarely explains them in real time. By the time the story becomes obvious, the easy gains are already gone. So the question is not whether silver performed well. The question is simple. Will you follow the crowd at record highs or position yourself where smart money is quietly moving next?